the Bitcoin ETFs, having this sort of release valve into these markets, if you will, and we saw them becoming the best performing ETFs in history, but we could think of them almost like a BlackBerry type of event.
In this world of massive capital pools, Bitcoin still represents just a tiny blip, a footnote. It's been largely inaccessible to traditional capital until the advent of Bitcoin ETFs. Moss likens this shift to the BlackBerry iPhone transition. Bitcoin ETFs, especially those built on solid treasury structures, are now acting as release valves, gateway products into this massive ossified capital system.
There's a wall blocking capital, and the capital is stuck. And we're trying to figure out how to get that capital unstuck so it can move. And specifically what we're looking at is a trigger. There's a $100 trigger that we can watch. And as soon as that trigger gets hit, we can expect a massive amount, I'm talking about $50 billion of capital to move. Now, what am I talking about specifically? Well, we know that in the world we have what we call store value assets, where money goes to get parked. Right? After you make your money, you spend your money, you save your money, it goes somewhere, typically into real estate, bonds, equities, into money market accounts, things like that, collectibles, fine art, gold down here, and maybe a little bit of Bitcoin right here in the corner. But what we have is we have about $300 trillion in bonds, plus we have about 115 trillion in stocks and equities, things like that. So we're talking over $500 trillion just right there alone. And the money is ossified. It's stuck in these different funds, different vehicles that have investing mandates. They can only buy junk bonds. They can only buy AAA rated credit bonds. They can only buy under certain mandates, and that money is stuck there. Now, on top of that, if these are holding like US government bonds, for example, in the last 5 years, they've lost 50% of their money. They're extremely risky, and they're only paying 4 or 5%. So I'm earning 4 or 5%, but I've lost 50% of my wealth. It's extremely risky to hold this debt, this credit, things like that. We're talking about pension funds that have hundreds of billions of dollars stuck here. We're talking about insurance companies that have to park that float, have to park it somewhere. We're talking about corporations that have billions of dollars in the treasury. They have to park it somewhere. And again, each one of these pools of capital are stuck behind a mandate. They can only invest into different types of things. They're stuck with, like I said, the volatility regulations that are there. Okay, so if we think about it, we got Bitcoin as this new entrant, as I showed you. It's like a little blip there. Right? And we can think about the ETFs, the Bitcoin ETFs, having this sort of release valve into these markets, if you will, and we saw them becoming the best performing ETFs in history, but we could think of them almost like a BlackBerry type of event.
This capital is desperate for higher yield with low risk, and Bitcoin-backed instruments are quickly proving themselves. Even a small reallocation, say 1%, would result in hundreds of billions flowing into Bitcoin-adjacent vehicles. With the $100 STRC trigger, Moss believes we'll see a cascading effect. First $50 billion, then $100 billion, eventually trillions.
He personally said, just on the last earnings call last quarter, that this is the iPhone moment. So what does that mean? Well, what it means is that this is the moment where everything changes. And why does it change? It's because STRC is now this gateway to some of the biggest pools of capital in the world. Let's just take a look at exactly what this means. As an entrepreneur, as a business owner, as a founder, we have ideas. We have ideas for new products or something like that, a new invention. But, you know, we use some market research and we use our intuition and our gut, but we don't really know how the market will respond until we actually put it out into the market. The market has to validate that for us, and that's exactly what happened with Stretch. As we can see here, it was the largest US IPO of the year. Now we can see that it wasn't just validated by the market by a little bit, but by a lot. As a matter of fact, we can look at the overperformance of that, and it's massive. They set out to raise about $500 million, $500 million. They ended up raising $2.5 billion with this, which is why it was the iPhone moment. It was like, okay, now we're on to something. This is a product that the market wants. What is it that they wanted? They wanted short duration, short-term credit, high yield credit instruments that provide good cash flow. What do you want? Most likely you want cash flow. Do you want 3, 4, 5% high risky stuff? Or do you want 10% in safe stuff? And of course we all want that. So it's sort of like a bond. It's sort of like putting money into a money market account, except for it's much more stable. and it pays much more. Like, you can think of it like a stable coin, but with interest. Here's the market that we're talking about specifically. So right now, we have money in bank accounts. The banks used to actually pay you interest. They don't really pay you that anymore. There's about 18.3 trillion in that market right there. The effective yield your bank is paying you is like 0.1. Maybe there's some high yield banks going up to about 4%. We have money in money market funds. So if you have more money, hopefully you're utilizing that with your broker. And there's about 7.4 trillion sitting in money market funds, and that might pay somewhere a little over 4%. Then we have money in short-term treasury bills. That's short-term credit. There's about almost $6 trillion sitting in there, and that's paying about 4.3%. We have commercial paper, so this is like corporate bonds, junk bonds, things like that. There's about 1.4 trillion sitting right there, and that's paying about 4.3%. Of course, now we have stable coins. I've been talking about that quite a bit. We just had the United States pass the Genius Act. They're trying to push stable coins across the world. There's about 250 billion sitting right there, but those pay 0%.
This isn't just theory for Mark Moss. He's all in. He's building Satsuma, a Bitcoin treasury company in the UK, and working alongside innovators like MicroStrategy to drive this revolution forward. He points out that today, we already have 160 publicly traded Bitcoin companies globally, and this number is growing fast.
STRC, stretch, it's not the whole story. It's only one piece of it, all right? What is going on here is stretch, strike, strife, and stride are all part of financial plumbing that is being built right now to tap into pools of capital. We're talking trillions of dollars of capital to pull that ossified capital stuck behind these regulated mandates and into a hard money Bitcoin denominated future, all right? So MicroStrategy has already created a full suite of what we call yield curve, as I showed you, different durations, different yields backed by Bitcoin. So shorter duration, longer duration, and it's targeting these different pools of capital. How big are these pools of capital and what are they paying? Let's take a look at this from another chart. This came from Strategy's Q2 earnings call. Okay, so this is just ETFs alone. So in ETFs, we have preferred equity. Here's how many assets they have. Here's the yield, and here's the liquidity. So we have between 6 to 7% yield that they're paying right now, and we have tens of millions of dollars sitting here. In high yield bonds, this is places where your fixed income, if you're getting retired or retiring one day, this is where your money would go. We have billions of dollars sitting here earning 8 or 9%. We have loans, ETFs with loans, and they're earning 6 to 7%. And now we have the 4 products that Strategy has created, Strike, Strife, Stride, and Stretch, all worth about $1 billion each, except for the latest one, almost close to $3 billion. But what's the yield? We're talking 7 to 10%. Again, outcompeting the market. And this is just on the ETFs. Let's look at some more comparable assets so you can just see how big this market is. So here we have US Treasuries, 28.3 trillion, earning 4%. We have mortgage-backed securities, 9.2 trillion, earning 5%. Bonds, 5 trillion, 5%. Junk bonds, 2.6 trillion, 7%. Preferreds, 179 billion, 7%. You get the idea. And again, strike, strife, stride, and stretch down here, all out competing them on the amount of yield that they pay on a more stable, on a much safer, stable surface. If we have a less volatile asset that's safer, that has more collateral, and it pays a better yield, more money will come to this, all right? It's just mechanical. It's a product that could bring in over $50 billion just by getting over that trigger, and then we're talking trillions from there. Has the potential to get over 100 billion in new demand, because as I showed you, there's over 30 trillion waiting to get in right now. And if we can get this trigger, the $100 trigger on STRC, it could be the spark that ignites the whole thing. That's how big this opportunity is that's happening with Strategy and the overall Bitcoin treasury space. It's why I jumped on to help build a Bitcoin treasury company called Satsuma in the UK, and it's why there's over 160 publicly traded Bitcoin companies now today, because we're talking tens and tens or hundreds of trillions of dollars of value. Now, if you want to know more about the Bitcoin treasury space specifically and how that's blowing up,
if STRC crosses the $100 mark, it won't just be another chart milestone. It'll be the starter pistol for the largest capital rotation in modern history. from decaying debt to Bitcoin-backed assets, from volatility to yield with integrity. Mark Moss has laid out the blueprint